Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. All right, well, sadly enough, of course, we put together a Netflix trade going into Good Friday, and Good Friday wasn't open for the markets, and so they announced on a Thursday, and because of I'll use this word softly, but because of the debacle that I created on Netflix and the fact that you couldn't trade out of it on Good Friday, I decided to do a video about option trading landmines. And on Good Friday, that was our subject. So if you'd like to learn a little bit more about exercise and assignment, about things to watch out for in options, and it's happening more often, honestly. I'm seeing option contracts that are getting deep in the money get assigned early. And I think it has a lot to do with the fact that there's no commissions on stocks anymore. So you exercise, buy the stock and sell, or you exercise and sell the stock that you already own. Bottom line is it's happening more often. And it's mainly because if options get deep in the money, the bid-ask spreads, especially on, kind of liquid stocks, like I would even put, UPS in there. I'm looking kind of over at my list. We have Home Depot is kind of one of those. It trades very heavily around earnings, but it doesn't always have great volume. Caterpillar is also a tough one. It's $285 stock. But when you get way deep in the money, the bid-ask spreads widen, and it just makes sense to exercise and sell or exercise and buy, because you can do that. And then you don't have to deal with the bid-ask spread. And then you're just dealing with the bid-ask spread on the stock. So don't fall asleep. If you have a position on it, in particular in puts, and they go deep in the money, like close the position. Don't allow yourself to ride overnight just because you got lazy. And that was the moral to the story on Friday. I don't need to rehash it. So go back and watch that video if you'd like. And hopefully you had a good Easter weekend. That is the main thing. Okay, so with that said, on the Netflix trade, we went out and we're looking at a skip strike butterfly for a decent credit. We were getting 40 cents to do the 1,050, 1,060, 1,080. We were going to do it one day, but then it turns out that the expiration date wasn't on Good Friday. It was on the day of the earnings announcement, which created chaos in the marketplace because the option contracts were going to expire prior to the earnings announcement, but they still had a boatload of juice in them. But if you're short options, you might get assigned and not know it. Right? And you wouldn't find out until Monday. So there was a lot of risk in that trade. Kind of decided to just not do the trade overall. Don't want to be short options. I could buy options going into that, and you could exercise or you could exercise those option contracts after the close if you were all prepared. But bottom line is, you would have made 4% on your $1,000. You could have made $40. It would have happened. Of course, we were right about the setup and everything that we wanted to do. Could have probably even sold it for a little bit more. But here's what happened with Netflix, and I'm showing it now. Let's go to the screen. I'm showing it on the screen. We're at 997, and I still like Netflix, by the way. So that's the reason why I'm talking about it so much today. And this is where the stock went. It went up to 9. This isn't Friday. This is that expiration day. So I guess, interesting enough. So this is the actual first day that the markets have been open and Netflix is moving, right? And it went up. And so this would be relative. So it went to 1,015 when we were setting up our call, our skip strike butterfly call was first strike was 1,050. So it opened at 1,015. One of the only stocks that I guess they think it's recession proof, and obviously no issues on tariffs. So Netflix seems to be the darling of the Meg 7 all of a sudden, and looking strong, right? But if we go and we look at the chart, it's going to have a tough time breaking through this level. And that was part of the reason why we set up the skip strike butterfly like we did. Our middle point where our short strikes were was 1,060, which is right here. Well, here's the bottom line. Markets are tanking again. VIX is still up. It's elevated at 33%. The implied volatility on the Netflix options is still trading right here. I'm highlighting it. Yep. Right around 50%. May 4th expiration. I don't think Netflix is going to, I mean, it's not involved in the news headlines. Most people aren't even talking about it. So I think it still has some strong upside momentum, up 25 today. But I think it's going to drift higher and vol is going to come down. So I want to go back and do the same trade, but just totally different. Let's go one standard deviation move out of the money. We're going to center it right around the 1,060 level. Implied vol has definitely came off, because of the earnings, just like normal. And we're going to look at going 10 points wide. We could even go 15 and we'd be pretty okay on 15. But then that's going to increase let's go 10. Let's do the 10. I don't mind the 10. Okay, here we go. This is where our trade is. 19 is the delta. That means in the next 4 days, we're looking at the April 25th expiration. And I do like this trade. I do like this one. I'm going to give like 2 thumbs up to this. Now, obviously, there's risk, but we could potentially get out of the market. Vol is just, hanging around. Historical vol is 49. We're trading around 51 in this expiration. A lot of juice on the 1,050s. Okay, we're going to buy this one. We're going to go out and we're going to sell 2 of these. We're going to skip the 70 and we're going to come out and buy the 80. We can get this done for a 32-cent net credit. Now, this is outside of earnings. So it's interesting. We got 40 cent. Well, now it's at 40. Yeah, I like that. I think I'd rather be in this one than at earnings. Now, obviously, with earnings, we were a little bit further out of the money because you had a little bit higher vol. So a 1 standard deviation move was further away than it was, now. But vol is still high. You're still talking about a 50-point move. And on the chart, in order to get in trouble, all right, let me zoom in over here. In order to get in trouble, you got to break through this recent high right at the 160 level. So this is where we're kind of thinking the market might go and stay. And we're trading right here. So yeah, I like this one a little bit better than I really did even around earnings. But we got out of the trade in earnings because of the landmine that I was talking about and that I went in great detail on the Friday show Education Friday that we taped for Good Friday, and the fact that the markets were closed. So this is going to be my official paper trade, and we'll send this to the what if calculator. And this will be the trade this week. Now, we got a lot going on this week. Tesla on Tuesday after the close, Boeing on Wednesday before the open, Apple is going to be on May 2nd, Intel and Google are going to be announcing on Thursday. And then, one that I'm kind of interested in is the NASDAQ before the open on Thursday. So only because some of the, which makes sense, got long some CME for a while. And that stock has, these are stocks that have done okay in the marketplace. So let's go all the way back since January, right? This is the beginning of the year right here, right? Look at that bottom right at 220 and ran all the way up to 275, came back down, but if anything, this volatility should be increasing trading, which it does. And earnings reports should be interesting, right? I'm not saying that nobody is thinking of that. So there are other people that are out thinking of it. CME was trading at a little bit better valuation. But so this is since the beginning of the year, right here. Okay, so we went up, down, and came back down. Now we're right at the 200-day moving average. Here's the 5th. That's the 20-day right there. And interesting if we can break up above the 200-day moving average. So the NASDAQ it doesn't have trades at a little bit higher valuation is what I'm trying to say than the CME, but interesting to see this momentum in a down market coming back a little bit, heading into earnings. Yeah, we're going to look at a trade. We're going to look that'll probably be our trade on Wednesday. I like the NASDAQ announcing earnings on Thursday. Anything else in here that I had written down? Oh, we got a couple of other trades that we need to review. So let's go to the what if calculator. The Apple long straddle. If you traded out of it, you did well. 195 is the strike. And I'm kind of curious if anybody had the positions on or has it on, if they got out. Doug saying you were right about the risk. Yeah, thank you, Doug. I see that. I survived. You were right about the risk. Doug, did you do the trade? Did you do the trade? Interesting enough. Because it did work, right? So I'm glad it worked because I would have felt bad because I went down the road without even really thinking the trade all the way through. I did. All right. Well, good. I'm glad you survived. I like it again, Doug. Now I like it a little bit better, actually. Vol is staying high. And like I said, 40 cents, you're getting almost you got to go. You're not quite going as far out of the money, but here it is. Here's the Netflix long butterfly. We're at 1,000. You're talking 1,060. And then that means it would have to break through a new high. And then at 1,070, that's where we're in trouble. You only got a 4-day trade. And it goes up to 1,080 here. You get 46 cents at this point in time. I like it right there. You're at about a 20 delta. So I think our delta was a little bit lower. I think we were at 15 or 16 delta on the other one as far as probability is concerned. But I like that one right there. I like it. Interesting. Next, if anybody did the long straddle on Apple, we're going to go back to the chart on Apple. You would have had to sell after the news came out about the fact that, and I'm going to paraphrase it here, but and it's kind of muddy, where the tariffs on mobile phones were not going to apply, which really had everything to do with Apple. But still, a lot of people have came back and kind of been confused exactly what's going on there. So Apple ran up, but then came down. And I anticipated that it would continue on up after that news, and it didn't. So in my own account, I didn't sell at the high end on the call. I missed it by a couple of days. But now, if you sold at any point in time after that news, which I think it was the right time. I mean, I don't remember what I said on the show, but it makes sense to me that if news hits and the stock doesn't move quite as expected, that you still get out. You still want to close because we were looking for news. And we talked about it on Friday, and the news happened on a Monday, but the stock just didn't skyrocket. It didn't take off. But now it has plummeted to go the other way, and it went all the way from, let's go look at the chart. I think we went up to 205 or 206, but it was really bearish on Apple after that. Okay, let's grab this corner. Yeah, because we came into this gap. We actually got up to 210. So that call option had to be trading for $15, if not more, because it still had vol premium. It still had, life in it. So you might have been able to get out for what we paid for it, which was $22. But if you didn't, I think I sold mine right around here, right when it came back down in this. Actually, this is the day I sold mine. The second day after the news announcement, right here is where I sold mine. And got out for like $12 or $13. It wasn't great on my end. But then the stock came down, and now it's down and it's going down. So you got the other leg on is where the call option is at. So let's go back to the what if calculator. So if you're long this put now, that thing is trading for $8.45 at this point in time. The 195 strike put. Let's send this to ticket. And you got earnings coming. So we purposely did May 2nd, right? Because we wanted it to hold the volatility. Didn't necessarily want to ride this into earnings. I didn't think of this as an earnings straddle. It was basically what's going on in the marketplace straddle with Apple, as opposed to trying to ride it into earnings. So I would look to get out of it. And then you would have been profitable on the trade. If you sold it somewhere around 15 on the call side, and then you leg out on the put side and sell it for about 8. And that's always the way that I'm going to approach long straddles. I'm hoping that on one side, you're going to get a small profit, a couple of, not a small, like a couple of dollars. You'd want to sell maybe the call for 23 or 24, and then let the put ride and see if it comes back. Because if we're doing the long straddle, it's because there's unrest in the marketplace, not a no news event like earnings, but there's unrest. All right, so there you go. It's looking pretty good if you did it right. And I still have the long put, so I'm going to be selling that put probably today. The straddle's $14 total, but I'll probably be selling the put today. Yeah, this is where you're at. And let's go in and look at Apple. And here's where earnings. So earnings are on the 1st. And this expiration, or I'm sorry, the earnings are on a Thursday. And that expiration date that we are showing there is on a Friday. Yeah, so Thursday is May 1st, and Friday is May 2nd. So there you go. All right, any questions on that trade? Is there anybody that has it on? All right. Now, if we look at what's going on in the market, and we're looking at the S&P 500 index, the good old SPX, I would still stay bearish on this trade. And VIX has jumped up again. Once again, it is a Monday, and we got more volatility, and that has a tendency to happen after a long weekend. Mondays are usually fairly busy. So, we can look at the SPX and decide, I mean, gosh, it's a tough call. Would we do Wednesday or would we do Friday on our put butterfly, the 23rd or the 25th? And the only reason why I'd say the 23rd is we usually have the show on that day. You know, the vol's up so much, I think we just keep it at a 2-day because we could adjust it tomorrow. So let's look at the 2-day one. So the 2-day would be the 23rd. So you got half a day today, all day tomorrow, and then all day on Wednesday. And these are the W's. So these are the weekly option contracts. We've been able to get these butterflies done for such a great valuation. I mean, look at this at the money option. We're talking about it trading at 35 vol and $58. It's just crazy to me. 52, yeah, I kind of wish it was a little bit higher, but we'll do it. We'll do the 55. Okay, here's going to be our SPX 2-day trade. That's what we're going to do this. So we're going to go down 15. Actually, you know, before we were able to go down 20. So let's try that again. Okay, so then we'll stop short at 15. So 51.50 down to 51.30. I hit the bid twice. 51.30. Boom, boom. And then let's go down 15 to 51.15 right here. Boom. Yeah, that's not bad. 20 points wide on our long spread, 15 points wide on our short spread. If we go below 51.15, this thing will trade for $5, putting it on for $275. And I want to pay $275. I don't want to pay $3 or anything like that. I want to pay that. And if I have to adjust it, I would rather, yeah, the market came down on me. Dang it. Like I would adjust it down 5 points and try to keep it right around the 250 mark to 275 mark. But I'll leave it as this for right now because we're getting to the end of the show. I'll send it to the what if calculator. I don't want to try to chase the market, in other words. But 275, that's really good for a 2-day butterfly. And so you have $2.75 worth of risk. If the market just stays where it's at or drifts lower, you're in heaven. If the market tanks, you're doing really well. If the market drifts higher, we can look at an adjustment, but that adjustment would probably have to take place tomorrow on Tuesday, which we don't have a show. But yeah, I don't mind this trade if you want to remain bearish on the market. I don't mind it at all. Let's zoom in a little bit on here. And this is, so since it is an open wing, now remember, I like to call the open wing a little bit different than other people. My vernacular with butterflies is just different overall. In my book, I don't like calling it a modified butterfly. I call it a skip strike butterfly. Why? Because we skip a strike and we embed a credit spread inside of it. It's exactly why I like to call it a skip strike butterfly, because it makes sense. In this instance, I'm calling this an open wing. Why? Because we're opening up the swing. We're giving ourselves profitability on the downside on this trade. So from our low strike, which is the 5115, 5,115 strike, from that point on down, we're still going to make, well, it's assuming that we did this for 290, or we can make 210 on that, no matter where it goes. It's all cash settled. So if it tanks, you can just let it ride. You don't have to get out of this. There's no reason to get out of an SPX cash index butterfly if the underlying market is all the way down here. I guess there's some risk as far as, you never know what's going to happen after the market. And you can obviously, once again, it's a landmine, you could be assigned. But if the market's way down and it's pretty obvious it's going to be way out of the money, just let it settle to cash, which is a huge benefit of trading the S&P 500 index. And that's where we're at. Any other questions? All right, everyone. If I don't see any other questions popping up, that's going to be it for this edition of Options Guide TV. We did a paper trade in Netflix, and we did a paper trade in the SPX. We have earnings coming up. We'll probably look at a NASDAQ trade when we get back on Wednesday. And also we'll talk a little bit more about the Apple trade. But if you are long that put, I would look to just get out. Especially, it's a Monday, markets are down. I don't want the cheese anymore. Just let me out of the trap. If you can get off for a decent gain in that long straddle, just do it, or even break even. I'm okay with that too. And that's it for this edition of Options Guide TV. We'll see you this Wednesday at 11 a.m. Eastern Time inside the Tradier Hub, hub.tradier.com, for the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.